Good morning, everyone.
Good morning. Thank you, everyone, for, oh, we're muted here.
Good.
We're good.
All right.
You can hear us. Shows on my screen that we're muted. Okay. Good morning.
Morning, everybody. I'm Matt. This is Brian.
Yes, I'm
happy to be here. It's my first time doing this, so bear with me.
It's Matt's very first time doing a webinar, so I'm excited to have him. I'm Brian Sherril. I'm the AVP over here of Inside Sales for Oaktree Funding. We appreciate everybody joining us today, learn a little bit more about investors. This is Matt Cefalo. He's an account executive on my team.
Happy to be here.
One of the funniest and friendliest AEs out there. So if you've had the privilege of working with him, great.
Yeah.
If not, then please feel free to reach out to either one of us after this call. We're going to try to keep this as informative as possible. The goal here is obviously understanding real estate investors a little bit more, understanding the mindsets, understanding how this all plays into the current market, what we're seeing out there. We're having a lot of success. Oaktree has always been, always had a good portion of their business coming in from investors. So we're going to talk a little bit about what we're seeing out there in the market, understanding the investors, how you could go out there and capture more of this business. For people on the call that are working with a lot of investors, I'm sure you could chime in and speak to the benefit of that. For those that are looking to pick up more business, we're glad to have you here.
Absolutely.
So we're just going to dive right in. These are the agenda items today that we want to really talk about, is understanding the different loan types available for investors, the different type of investors that you're going to come across, how to speak to those borrowers, how to strategize with those borrowers, how to really become an expert in this field, how to get your borrower to maximize their returns, or at least have those conversations and really, you know, sound like a professional, sound like you know what you're talking about. So hopefully we can give you some good talking points by the end of this. And then at the very end, we're gonna have a Q&A session. As we're going through this, we're gonna kind of save all the questions until the end. So feel free to go through the as we're going through the presentation, to comment in the chat, and we'll make sure to get to all those questions at the end of the presentation. So, understanding different loan types. Traditional bank loans, pretty self-explanatory. You have a cookie cutter borrower, W-2, everything's super clean. They can go to their bank, they can go conventional. I assume most people are familiar with these type of investors, but just know that with investors, they're always looking for new loan products because a lot of them don't fit into these traditional molds. So Matt, what's some examples of borrowers that wouldn't fall into those categories?
Yeah, I mean, a few examples is maximum 10 properties. They don't allow for any more 10 for investment. Non-warrantable condos we see a ton of, obviously for the reason of not being able to go traditional, and 5-day unit as well.
Yeah, so it could be any myriad of reasons. Maybe the borrower's self-employed, they don't show enough income. Maybe they have 100 properties and they can't go Fannie and Freddie, nor would they want to, because it's just a lot to unwind there when you're trying to qualify a borrower that has that many properties and has that much rental income coming in. Absolutely. Getting the leases, getting, you know, so a lot of borrowers in this space, especially the professional investors, have been kind of conditioned over the years to go to the hard money market. And so our goal, and those loans are great in certain situations, but it's not the only option. And so bringing these products to the forefront, getting our originators and our real estate partners educated on this stuff, so that you could go out there and cast a wider net, is always our goal. And we're going to dive into some of the more granular stuff. Hard money loans, we mentioned that. These are typically short-term financing structure, right?
Usually higher interest rates. They charge usually more points. Sometimes it's a balloon term. And then we have, you know, the private money loans, which we don't see a ton of. They're kind of more of one-offs, but those are out there as well.
Yeah, you'll see some of this out there in the market with the private money loans. People that they work out a deal with the seller. The seller's going to carry the financing for a finite amount of time until the borrower secures their funding. So there's a lot of bright spots when it comes to investors, especially in this current market where, you know, we're up against interest rates, where a lot of borrowers are kind of on the fence. If there's any bright spot in the refi space, it's been in the investment space. And I was just reading a couple weeks ago that it said 90% of all millionaires become millionaires through real estate. So it's a product that sells itself. People understand the benefit. The people that have been doing this for a long time understand the benefit, and they've obviously already got there. But then you have first-time investors too, the individuals that need a little bit more guidance. And so how do you become the expert? How do you know what the questions are that you want to ask?
I think the main questions you want to ask to start out with is, do they own a primary? You know, have they been paying obviously that first mortgage on their primary? What their goals are? What is it going to rent for? Is it going to be short? Is it going to be long term? Like, what are their goals with their first investment property they're going to be purchasing?
Yeah, and what's their exit strategy? I mean, that's hugely important. If you have somebody that is a first-time investor, these are the questions you want to ask. Do you own a primary currently? If not, then do you rent? What does that look like? Comparing the subject property to their existing residence.
Making sure it's not inferior, or it's the same value in square footage.
Right, so you don't want to have somebody that lives in a $250,000 home and now they're trying to all of a sudden run an investment for $3 million.
That just doesn't make sense.
It's just not going to work. So, but getting sharper on what questions to ask. So, in addition to do you own a primary residence? What are your goals? What are you looking to do in the short term? What are you looking to do in the long term? Are you looking to capture just residual income each month? And if so, what's the plan with it? Are you going to reinvest that to buy down the equity in the property to establish more equity position? Are you going to use that to offset, just monthly expenses? Or is somebody buying with the idea that, the market's strong and the property value is going to go up, and so they just want to put a tenant in there, be at a break even, gain the appreciation in 3 to 5 years,
Cash out, get another one.
Sell the property, or get cash out against the property. So
yeah, absolutely.
So we have foreign investors and retail investors. I'll touch on the retail investors. These are people that are a little bit more hands-off. It's more passive. They're not buying real estate. They're buying REITs, investing in the stock market, that sort of thing. People are probably familiar with it. REITs, for those that aren't aware, it's basically traded like a stock ticker. So you can actually go out, and these REITs hold big portfolios of commercial real estate, residential. It's usually a blend of the two. But we've actually seen an uptick in foreign investors. So
yeah, I mean, I get a few snares a day about that. I don't want to dig too much into it, but we do offer the program. We fund quite a few of them, and I mean, it's great,
It's good to have options for foreign investors. So you have people that maybe aren't U.S. citizens. You have I-10 borrowers, stuff like that. So if you have these scenarios, let's talk after this, because it can be a little bit more in depth. We can help get you a little bit more well-versed with how to work with these foreign investors. But we have seen a huge uptick in this business. So loan eligibility criteria. I'll start with the professional investor. This is kind of a different animal. For them, it's all about divide, stack, multiply. We have two separate programs. We have our Investor Advantage program, and then we have our professional investor program. And there's some differentiating factors with these types of borrowers. The kind of conversations you want to have with these borrowers is going to be completely different. Somebody that's a professional investor, they've been in the game. So maybe they've been doing fix and flip stuff. Maybe they're doing fix and hold. They're renovating property. They're just churning and burning. Maybe they're holding 50 properties and they're just collecting rent on it. And the name of the game for them is always secure the next round of liquidity so they can continue. They're always
looking for opportunity in the market. Usually they have like 50 to 100 properties. We see that quite often, which is great, right? More properties, more experience, the more exceptions you can get, the more products that will be available to you.
Yeah, and that's absolutely key. The experience level really will dictate the product mix available for the borrower. So as an example, we list 5 to 8. This is a product that we've also seen some traction on, because in the past it's been considered more of a commercial product. So with the 5 to 8, we can't do that with somebody that's a first-time investor, but somebody that's a professional investor all day long. So we're seeing more of that business. And then we have a blanket loan product. It's also referred to as cross-collateralization. So maybe you have a borrower that has a large portfolio of properties, anywhere from 3 to 25, and rather than doing 25 separate loans, You could actually do it all in one loan under the blanket product. So this really comes in handy, especially when you're trying to overcome some of the loan limitations, right? So
our minimum loan amount, for example, is 150. We won't take anything underneath that. But if you have, 20 loans at 75K, it makes sense. And it's much easier to do as well.
yeah, and with that exactly. So the blanket product, you may have a borrower that has, let's just say 10 properties that are worth 120 each. They want to do loan amounts 75 per, so $750,000 loan structure. Typically, you wouldn't be able to get those done individually just because of the lower loan amount, but this is a product that kind of bridges that gap. So there's a lot of options. And then not to mention, we won't dive into it today, but there's a lot of short-term lending options from fix and flip, fix and hold, bridge product.
Absolutely.
Oaktree just acquired a sister company, Truly, so that we could start focusing on some of this business a little bit more because there's been a huge interest in it. So that's the professional investor, right? Now we're going to go back to your regular kind of mom and pop individual investor and some of the common questions that we get about our loan product. So
can we close an LLC? You hear this almost every time a DSCR file comes across your desk, and of course we can. We just need a personal guarantor, articles of incorporation, some things we need, but we can absolutely do it. We have IO available as well, which is huge for DSCR.
Yeah, and so we get this question a lot. Can you close in an LLC? Yes, we can close in an LLC. There's some benefits to doing that from the borrower's perspective. So again, getting yourself familiar, what are those benefits? Well, it limits their liability. There can be certain tax benefits. I would definitely recommend anybody looking to pick up more of this business, spend a little bit of time with some professionals out there, whether they're tax preparers, CPAs, financial planners, and ask them, what's the benefits that you see for your clients that own real estate, and how can I use those talking points to, educate my borrowers a little bit more? It'll be a good investment of your time. And the nice thing about the investors is that it's kind of a repeat business model. So you become a little bit less reliant on your typical referral sources. As an example, we have one of the account executives on my team. We just closed a series of loans for a borrower. The borrower submitted 10 loans to us. They were all loan free and clear. Value was $500,000. They wanted to pull out about $300,000 per property. We just got those ones done. They said, we'll send you 10. Once we get those done, we'll send you another 10. But understanding their mindset, they're pulling that cash out. So 10 loans, $300,000 loan amount. We're talking about $3 million. They're taking that $3 million and then they're going to go invest it in more property typically. They're looking for deals. And I just read the most recent NAR report talking about the September results. And it said that 29% of all transactions in this market last month were cash. So who are these people? Who are these mysterious people that have all this liquidity? A lot of them are investors. Now, you will have some people that maybe they lived in California, they sold their house, they made out like bandits, now they're looking to move into a cheaper market. You have those borrowers. But a lot of them are investors. So investors will come in, they'll already have the cash secured, typically through the financing that we offer. They're going to come in and try to make lowball offers. For them, they're just looking for deals. They're less concerned about the interest rate. They're less concerned about the terms. How can I get a good price? And how can I get a cash flowing property so that I can start to establish more equity in that position? And then once that's done, it's just rinse and repeat for them, right? So how does non-QM fit into this? Well, we have some loan products, and Matt can talk a little bit about some of our big products, right? So what do you see out there?
DSCR, man, right? So what's great too is the IO option for our DSCR program. I can't tell you how many times I've had a file come back and it's right there, right? The ratio is at 0.98 and we flip to IO, and that gets to qualify. They can stay at their LTV they want. The rate's not going to move on them, and we can just go from there, close the loan, everyone's happy.
So for those that aren't familiar with DSCR, I'm sure there's people on the call that have. If you've done DSCRs, go ahead and drop an emoji in the chat and let us know. These are great loans for borrowers. These are great options because rather than looking at the income, they're just looking at the cash flow of the property. The DSCR stands for debt service coverage ratio. So does our proposed PITIA payment get covered by the market rent that's on the rent schedule?
And these are no income, no employment loans. We want all the REO listed, all the REO they own. We want the mortgage liabilities on there as well, but we don't see any rental income. If they are investment properties, And they're pretty simple. Just got to make it ratio.
Yeah.
Get it close.
And obviously in a rising interest rate environment, that's become a little bit more challenging, but we have some different options. Like Matt said, we can qualify the debt service with the interest only payment. That's huge. A lot of people want to use the interest only payment anyways because it helps the property cash flow a little bit better for them. So there's usually a rate adjustment to go interest only. A lot of borrowers will buy this down. For any of our realtor partners on the phone out there, negotiating on behalf of buyers, this is where negotiating the seller credits, the seller concessions can really be beneficial because everybody's a little bit more rate sensitive in this market.
Definitely.
Getting that concession, even if it's a 2% concession from the seller towards the buyer's transaction, can buy the rate down or buy out some of these loan level.
Which we are seeing too. We have seen an uptick in that, absolutely, even on primaries as well.
Right. The market's still strong. I mean, it's still appreciating overall. Geographically, there's some spots that are doing better than others. So I don't know what market everybody's in. We're here in Phoenix. It's been a little bit of a mixed bag, but prices are holding strong. And I think the reason for that is obviously there's so many people that secured a very low interest rate when interest rates were at their all-time low. And so how does that translate, right? You have people that probably want to buy, they want to do some things. So, and how does that play into the real estate investment market? If you have that borrower that's sitting at a 2.875 and they're like, well, I don't really want to do anything with this property. I don't want to sell at 2.875 only to get into an 8% rate, right? We're hearing a lot of that. But what we're also seeing is a little bit of a shift where those borrowers are making that residence that they have the 2.875 a departing residence. They're turning that into a rental. Accidental landlords, they call it. Because they see the benefit of just holding the property, and the rents are very strong right now. Pretty much across the country, we've seen strong rent growth. So they're turning their primary residence into a rental. They're cash flowing it. They're maybe using that cash flow to offset the higher interest rate on their new primary that they're buying. It's very savvy. I've been taking mental notes. I'm looking to become a real estate investor in 2024 because I want to be the 90% that became millionaires. So strategizing on that, you're starting to take the steps. Hey, are you opening in an LLC? Have you thought about going interest only? Have you talked to your financial planner about what the best way to this loan structure would look like for you? And getting that advice and getting all parties to the table so that we know. If you're educating your borrowers on this stuff, you'll have a client for life. They'll know that they care about their objectives. They know that you care about their goals. They're going to come back to you 5 years later and say, hey, the business that we've done has made me a millionaire. Thank you.
And to touch on that point too, those borrowers locked in at that 3% rate, those 2s, those 4s, we can actually do second liens on those. Without touching that first, still pull cash out to either another investment property or anything BITIA related. So we are seeing a ton of that. I get about 2 or 3 in a day. So that's obviously another great option as well.
Yeah, and so reserves, there's reserve requirements. We can use cash out for reserves on cash out transactions.
Of course, yep.
It's a minimum of 3 months. Sometimes it can be a little bit higher. We base it personally on the loan amount. So anything up to 500,000 is 3 months. Anything for 500,000 to $1 million is 6 months. So on.
So on 12, correct?
Yeah. So, but we can do cash outs. And for those of you that have seen the market shift like we have, where we were doing probably about 50-50 purchase consistently for years, 50% purchase, 50% refi.
Now for what, 70-30?
Well, I've heard a lot of people say they have no refi transactions in their pipeline right now.
Yep.
So how do you pick up more refi transactions? Investors.
Absolutely.
They're all, for them, it's less about the interest rate. It's more about the capital.
More about the opportunity.
Yes, they're looking for opportunity cost.
They see a deal, they're on it.
Yeah, and they have the tenant paying their rent, so it really doesn't matter as much for them, right? Matt touched on this earlier. One of the reasons that we see a lot of borrowers come and go non-QM is because of the number of finance properties. So obviously Fannie and Freddie has some restrictions there. We see a lot more of these borrowers than you would think. I'm actually shocked by the amount of people that own 10, 15, 20 properties. It's astounding.
And we love to see it too. It's great.
Yeah, and I read that 40% of all real estate in the United States is free and clear. So think about that. Is it the borrowers that are just paying their mortgage every month, living in the property? Sure. There's some of that. Maybe you have borrowers that inherited some property, or they got into it with a super low liability. But a lot of these realistically are investors that own these properties free and clear. It's just an income source for them. And then as needed, in a market like this where they feel like they may have some more opportunity to negotiate deals, they're looking to raise money. So something to definitely keep on your radar. With our investor products, we can do, this is another reason we get a lot of them, right? Stuff like non-warrantable condos.
See it all the time.
Yeah.
The first thing I'm going to ask you to do is what makes it non-warrantable, and then we dive from there. But we get a lot of these as well.
Yeah, we can do multifamily, so we're seeing more of this, 2 to 4 unit. We can do 5 to 8.
We don't see a ton of it. We can do condo hotels as well.
Yeah, so I mean, if you were to go out and just look as an example, if you were to just go out and look in your local market and say what properties are available for sale, let me just narrow it down, put some filters in my search, and just look at the 5 to 8 product. You'll notice that the time they sit on the market is typically a little bit longer, and the reason for that is that people have a hard time securing the financing because it's considered more commercial. So how great would it be for you to be able to take that property, go to the real estate agent, say, I have a loan product for that, for anybody that's interested in the property, get them in contact with me. It's a good in. Same thing with the 2 to 4 unit. They tend to cash flow a little bit better, so investors love these.
We still do 80% on them as well, which is great. 8% down. Seeing a lot of those. Yeah, they do cash flow much better using the 1.1, 1.25 area. So that's what we want and expect.
Yeah, and on the debt service coverage ratio, if they do cash flow a little bit better, typically the pricing will get a little bit better.
Absolutely,
as well.
Yep.
We actually just rolled out a variation of our DSCR product that's a little bit sharper in price. It's a little bit tighter in guideline, but it's for these type of borrowers, high FICO borrowers that are cash flowing their property really strong. So if you're coming across these, we'd love to price them out for you. Condos, non-warrantable condos.
Mm-hmm.
Rural can be problematic.
And acreage as well.
And acreage.
Yeah.
Yeah. So make sure to ask those type of questions. Ask the borrowers, what type of property are you looking for? Why does it matter if you're doing a condo versus a single family? Well, if you're doing a DSCR loan, HOA.
HOA, that's going to be factored into that payment, and it's going to sometimes can affect the ratio.
Absolutely.
Yeah. So.
And this is really what it's about. My eyes are getting terrible. Sorry. They're quite right.
It's more till it looks good. You're fine.
Thank you.
I got you.
This is what it really boils down to, is maximizing returns for your borrowers. So what are they looking to do? Understanding their objectives, understanding the risk. Hey, what's your market look like? What's it done in the last 24 months? What happens if the market goes down a little bit? Are you going to be able to weather that storm? Are you planning on, selling the property in a year and just gaining the appreciation? Or are you planning on holding it for 5, putting a tenant in there and establishing, some equity position?
Finding up that end goal. Yep.
It's huge. And start breaking these numbers down and providing them with resources that are going to be helpful for them to make an informed decision. So do you have a property identified is another great question. Or do you have an area identified? What type of property are you interested in buying from an investment standpoint, and why? Why does this make sense? Is it in a touristy area, right? We see a lot of
Florida, right, near Disney, stuff like that.
Or coastal regions.
Absolutely.
Yeah. Tennessee has been a huge market, surprisingly, for a lot of this.
Which you wouldn't expect. We haven't seen it. Absolutely.
Right. Are you planning on using it as a long-term rental or a short-term rental? That's a good question. Has it been used as a short-term rental in the past? And if so, we might be able to use that short-term rental history to qualify the property as well.
You can get a ledger, a 12-month ledger from the seller, or if the appraisal comes back and there's a lot of short-term comps, you can use that as well. So it really just depends on that property by itself.
Yeah, we've seen a lot of people jump into this space, especially in these touristy areas, because they realize that on a nightly basis they can cash flow the property a little bit better. Some prefer the more traditional model where they have a tenant in there and it's not as hands-on as far as the property management. So understanding what your borrower's objectives are. What do those returns look like? Have you run a rent analysis? That's another good question to ask. This is a good opportunity for you to talk to your realtor partners as well. Hey, I have a potential buyer here. They're looking in this market. They're looking at this property. What do you think the comps are going to be? how's this going to cash flow, vetting that a little bit tighter up front. We can help you with.
And sometimes AirDNA is a great way to look at that rental and kind of what that market's doing and where everything's at.
Yeah, especially on the short-term rental side, AirDNA is a great resource out there. So just knowing what tools are out there to help educate your borrowers. What do their returns look like? Are they looking at the monthly returns? Are they looking at the overall return, right? You may have somebody that says, okay, I want to buy a $500,000 home. I'm going to put, $200,000 down on it. I'm going to use whatever cash flow of the property to pay down the principal a little bit further. And then in 5 years, I plan on selling. Well, it makes sense, right? If even in a normal market that's doing 3% rate of return, $500,000 property, they're gaining $15,000 a year. So over a 5-year timeline, you could do the math, $75,000 in appreciation that they're getting. Maybe they've paid it down another 30. Now they've made $100,000 and they've had somebody else paying the mortgage the whole time. So understanding this a little bit better. Whereas with a professional investor, they're already going to have this plan laid out. So expect that. They're already going to know, they've already done their homework on what the rent schedules look like.
Oh yeah.
They've done the homework on, or if they're doing it as a fix and flip, here's my budget, here's everything I'm buying. They have it all detailed out.
Here's the ARV, here's what's going to happen, here's what I want to do. I'm not going to hold it, it's going to be flipped. Or maybe it will make sense to hold it, which you do offer, fix and hold as well.
Yeah, and asking them the questions. What are you seeing in the market? How do you feel about this market? Are you a buyer? Are you holding? Are you not doing anything? Picking their brain, the people that have been doing this a long time, is going to give you a lot of insight. And I feel like here, because we do so many of these loans, we get a lot of really good nuggets on why investors are looking to do what they're doing and what their line of thinking is. And so if you want talking points to this, if you want to get more familiar with this, we're always happy to spend one-on-one time with anyone that wants to learn more about the loan products available to them, how they can get in front of more referral partners or in front of more of these borrowers. But the nice thing is these borrowers the professional investors, they tend to run in small circles. Right?
Everyone knows each other in that industry, it seems. Everyone in that market, everyone knows each other.
Yeah, we're in the Meridian building in Chandler, and downstairs every month they have a huge meeting of all these real estate folks and real estate investors, and they'll come in and chat with each other, network. It's the best investment of your time. If you're not doing any of this business, it's probably the biggest opportunity that you have out there, and that's what I hope you walk away with. But if you're not sure on these products, or you're not sure how to get in front of more buyers or more borrowers,
How to structure the deal,
what questions to ask, what to look for, please reach out to us. We know this stuff. We've been doing it since the very beginning. I know there's a lot of shops offering DSCR products and similar type products out there right now.
We talked a lot about DSCR, but DSCR doesn't really make sense for everybody. A lot of times you are at that mercy of the appraiser, what that market rent's going to come back at. And we can't go income qualifying on these, right? So, if you have a bank statement borrower who's been self-employed for 2 years, and sometimes we get exceptions with 18 months, we can the rates are going to be better than DSCR, and they don't have to worry about that ratio at all. We just qualify them off the income, and they're good to go.
Yeah, so we see this with a lot of self-employed borrowers. We'll actually bring in a lot of loans that start out as a DSCR, and we end up having to pivot it because of the market rents right now. It doesn't quite ratio with the interest rate. So we're always going to find creative solutions to help get the deal funded. Oaktree, we really pride ourselves in getting deals done for our originator partners out there, creating a smooth transaction, hitting our closed escrows, making sure people are happy. So we'll work very hard for you. So definitely give us a shot. But yeah, understanding what the borrower's end goal is and how you can sell the benefit, but also educate them on potential risk, especially for the first-time investors. The professional investors, they tend to know what
they'll tell you what's going on.
Yeah, they'll tell you what the risks are in the project. Exactly. So we just touched on this, so I think we got a little bit ahead of ourselves. So,
yeah, we kind of rambled a little bit.
But here's some additional talking points. So, monitoring the investment performance, helping them set up some spreadsheets. I have a guy that I used to actually work with in a different field. He's now in real estate. A good friend of mine, Josh Hogan, I've seen his Facebook feeds, and he's working on some flip projects, and he's working on some short-term rental projects. And recently he had shared a spreadsheet on the performance of his properties. And so he had 2 short-term rentals. His initial one, which was a little bit smaller, and then I think he got another one that was a little bit bigger. And he tracks this performance detail. He knows what the occupancy rates are. He's doing it on short-term rent. He knows what the occupancy rates are. He knows down to a science how these properties are cash flowing. So it really gives him a leg up on his next acquisition, right? He's cash flowing both properties, fantastic, but it's always looking for that next thing. And that's kind of the mindset: divide, stack, multiply. Informing them of specialized lending products. I feel like really this is the entire value of the broker channel, that brokers just have a wide basket of products available for a wide basket of borrowers.
Absolutely.
So knowing what products are out there, this market is constantly shifting. There's constantly new stuff, changes to guidelines. So partner up with people that are experts in these loan products, and you will get more deals if you just invest even a minimal amount of time into this. We talked about educating people to the risks, encouraging the collaboration. So anybody on this phone call that's getting referrals, where they usually get referrals from? Loan originators?
Oh, real estate agents typically?
Real estate agents?
Yeah.
Or past clients, maybe they'll refer them some business. But I've worked with originators that don't do any of that. They get all of their business, 100% of their business, from either tax preparers or financial advisors. Because maybe the borrower is self-employed, they run a successful business, they're making a ton of money, but they're writing a lot of it down, so they can't qualify conventionally. So these are type of borrowers that we can help. And we'll kind of go through some scenario examples at the end of this to paint that picture. But what if you could get in front of more financial advisors and tax experts, say, hey, I've got some product out there that may benefit some of your clients. Can we set up a meeting? Can we talk a little bit about it? Usually they get really excited because then they have something that they can go to their client. And just like you, it's cross-selling constantly, finding ways that they can position their borrower a little bit better, because they understand the better you can position that person, that individual, the more chances are that they're going to get the repeat business, that they're going to get additional business. This is how they grow. At the end of the day, this is a relationship business. So you have to really stand on this stuff. You have to know the tax benefits, the financial implications, and it'll make you an expert. I've known folks that have done 0 non-QM, shift and go into this product, and now they do 0 conforming deals. They're just doing non-QM. Our top account executive, the top originator that he works with, they do 100% non-QM, and they're with one of the biggest shops in the country, and they're one of the top performers of that company, just feasting off of this product because it sells itself. So
absolutely, yep.
So continue development, stay updated, talk to your account executives out there. We're not saying it just has to be us. There's different lenders out there that have different products, but we definitely want to be the go-to. If you have these type of borrowers, we can tell you right away how to structure it. If you have more complicated LLC structures, we can kind of talk through that, peel back that onion. Anything you need to help us win you more deals, we're happy to do.
So, absolutely. That's what we're here for.
So Matt mentioned AirDNA. We didn't put it on here, but these are some websites I mentioned earlier. If you want to go out and look at what's out there, 5 to 8, or even some of the 2 to 4 unit is being marketed through RoofNet and Prexy. But knowing what websites are out there to help you understand rent analysis, that's going to help you understand cash flow, etc.
It's a great way to start. It's not always super accurate to the market rent, but it's usually pretty close.
Yep.
So
we have some other resources too internally that we use that we can talk to you about too. So we've got some scenario examples we put together. Give us just a second here. There we go.
And I'll break this DSCR one down here for a little bit. So if you look in the middle column here, which is DSCR, I have the scenario written out for you, and then really breaking down the DSCR. So the rate's 8 1/8, P&I payments $25.98, that tax and insurance PITI $30.98, and our market rent's at $3,400. So really all we're doing is taking that market rent of $3,400 and dividing it by that PITI payment, and that's gonna give you a ratio. In this case, it's 1.09. I know some people always ask me about the math, so it's truly just that easy.
Yeah, and to that point, this one is just shy. So at 1.09, I know that at 1.1, we could probably get a little bit better pricing. So this is where we'll start talking about things like potentially IO or.
I was trying to be a little realistic with today's rates. So.
Yeah, maybe buying it down.
Yeah, absolutely.
Bit. But
in this case, you definitely
again, to really drive this home for the originators that aren't familiar with this product, you're not going to put on the 1003, you're not going to put anything in the employment section. You're not going to put anything in the income section. You're going to fill out the REO, but only list out the mortgage liability, the taxes, the insurance, and the HOA.
No rental income if it is investment. See that come through a lot. I'm like, hey, you got to fix this. We're not going to want to see it.
Yeah, we're not interested in knowing what they collect on the other properties that they may own. We're going to assume that if they're continuing to grow their business, they're cash flowing those properties. So that's one example of a product. So we've also got bank statements here.
Mm-hmm. Yeah, so in the scenario here, still investment, just income qualifying. The rate's slightly better, which is great. I mean, it makes, like I said, you don't have to worry about the mercy of the appraiser, right, where that market rent's going to come in. You don't have to dig through our DNA to get an idea. You're simply just qualifying them off the income, and that's just another great way to get it done. Like Brian said, sometimes they come in as DSCR, and then we do flip it to income qualifying to make everything a little bit easier.
Yeah, and if you're not sure which direction to take it, you've got a self-employed borrower. You're saying, well, they could go bank statements or they could go DSCR. I always recommend go bank statements. It's going to get the borrower the better deal.
And if you're unsure of that income, just let me know. Give me a 3.4 file in the bank statements. We'll get it calculated for you so we have an idea what they can qualify for and kind of where we're at. So it's really just as easy and simple as that.
And that's a really good point. We have these resources available for everyone. If you're not sure what the borrower is going to qualify for based on their self-employment, reach out to us. We can tell you, here's the income that we're going to use. And that way you can take that borrower out shopping for the realtors out there, work with your originating partners on this stuff. If there are realtors on this, hopefully, and you have self-employed borrowers, just know that there's product out there for them. And for these investors that are doing a lot of deals, this DSCR is a much more viable option if they can go that route versus going hard money. They're going to get much better terms. It's going to be more long-term finance structure instead of.
In a year, they're not going to be scrambling to figure out what to do, who to take it to.
Yeah, hard money will balloon in a year. They're going to say, we need the full note due. So we can give them a better option than hard money. Sometimes.
Definitely.
Hard money's got its time and its place. Don't get me wrong.
Yeah, of course.
And then to Matt's point, for all those borrowers that have investment properties and they have a super low interest rate, we do have a second lien product. It's not a HELOC, but a HELoan. So it's dispersed, all at the time of closing, right? But you have that borrower that has investment properties. They want to tap into the equity, but they don't want to touch their low rate that they got a couple years back. So you can offer them this product, get cash out. We can get up to, on investment property, I think we can get up to 80%.
LTV, it really just depends on the FICO and the loan amount. I know we have a newer matrix that slightly changed, so it is FICO to loan amount based now.
Yeah, we raised the loan amount, the max loan amount.
550 now, minimum still 75. We can do 2 to 4 units on this, and we can do condos that are warrantable as well. So if you see any of that, please just let us know. But yeah, this is great. I mean, I see these all the time. We do these on primaries and second homes as well. And in this scenario, I did put full doc, but we can do it on bank statements as well. So it's just a great alternative.
Yes.
Give them the cash they want, use it for whatever.
And these are just a couple examples of stuff that we see all the time. I run a team of account executives here. I probably get 30, 40 scenarios a day that are coming across my desk. How do we structure this? How do they work on this? We know this product. We close a lot of these loans. So please give us a shot. Hit us with your questions. If you want individualized training, we can set up something just like this where we get on a Teams call with you.
Get your buddies, get your team with you, and we can go over everything.
Same thing for our real estate folks out there. If you're looking to get more familiar so that you can cast a broader net and then work with your originators, let us know. If you're not sure, if you don't have an originator, the partner that's doing this type of product yet, reach out to us. We could probably get you paired up with somebody that's pretty familiar. And hopefully help everybody close more.
And in DSCR, you can actually originate in most states, not all states, even if you're not licensed. Let's say you're licensed in California, you want to do invest property in Florida, that is possible to get done.
Yeah, so it's considered a business purpose loan, so it doesn't follow TRID. They tend to close pretty fast. The DSCR loans, they don't require the rescission and that sort of thing. So we can get these loans done in
just about, I mean, most states. There's some states that have caveats, but most states we can get them done.
Yeah, we get them done quick, about 14, 21 days. So. Whew,
And,
that was a lot of information.
Yeah, I mean, any questions? We pull some questions up, see if there's anything in the chat. Can we get a fire emoji for Brian and his blazer, please?
Fire emoji. There's Matt's information. Here, I don't know if they can see this screen. We'll get to Matt's information. Matt and I, we're working through scenarios all the time, so reach out to him after this call.
Closing LLC, the principal stuff, guaranteed loan, and do we personal credit score? So we do use a personal credit score. Typically, the way I usually run these to make it easier, if there's multiple people in the LLC, get the person who has the highest credit score qualify that way, obviously agreeing a better rate, and then just keep the remainders off the loan and just use that one guarantor.
Yeah, you don't have to put all the guarantors on. They just have to be a managing member, have at least 25% ownership. But we do, we require a guarantor on all of our loan products.
Will there be a recording of this? Luke, will there be a recording after this?
Yeah.
Yeah, there will be. Yep,
we're recording it, so we'll make sure to get that out there. If you want a recorded version of this, just reach out to us.
Any other questions? We still got a little bit of time here, so feel free to throw anything in there.
Anybody, any scenarios? Anybody had success?
Anybody done DSCR? Where are you guys from?
Where's everybody from?
Yeah, where are you guys at?
We got a little bit of time. We're here to help you, so hopefully this has been helpful. Anyone? Nope. Okay, well, we appreciate you joining us. If you don't mind, just put up Matt's information here, Luke.
Yeah, if you guys have any questions, please reach out to me.
Okay, so, okay, so they can't see the chat that we're seeing.
Okay, gotcha.
Perfect. So all of Matt's information is here. Please reach out to him. We hope that we hope to hear from all of you, and thanks for joining us today.
Thank you so much.